I'm going to go through the one common trait I've stumbled into that has led to this company going from 35 pence to 51 pence. This company that went from $55 to $140 shortly after. And this company that went to from 75 cents all the way to $1.10. Now, I'm not necessarily interested in trading these short-term moves, but it is a common trait that I've found in what I believe to be undervalued companies and has helped me to identify businesses which I think are going to be successful in the future based on these common traits that don't necessarily all pull through in the same way. So I'm going to give a breakdown on all three, and then as a bonus, I will then sort of go through the specific context on all of these as well, just so you can understand the situation a bit more, because everyone looks slightly different, but once you're able to recognize the pattern, to me, it then starts to seem all very similar. So let's start off with the first one. This is a small cap in listed on the AIM. It is called DFCH, or Distribution Finance Capital Holdings, DFCH. The business specializes in asset-backed lending and in effect had been interested in investing in this business from a perspective that the business is growing. It's been growing 20-30% plus historically, something that it can continue doing at probably 20% going forwards. Business at the time had been trading about 4 or 5 times forward earnings, dirt cheap. I mean, arguably could still make the same argument today. And one of the things that I noticed with this business in particular that stood out to me is that the business in the short term had been beat up just because of some effectively non-fundamental reasons that have driven this company down. So what I mean by that is there was a major shareholder that had been forced to liquidate some of their position due to the fact that they had redemptions in their fund, and as a result of that, that means that they had to sell DFCH whether they liked it or not, even though the business was already at arguably cheap valuations. Again, this had nothing to do with the fundamentals of the business itself. And when you look at this stock chart, again, not something I reference too often, but it's helpful to sort of understand what's happened here. Is you will see that actually after the sale, the business started recovering very swiftly. You can see that the stock almost doubled from $30 to $50 at a peak of 55. Again, not too bothered about the short-term technicalities, but for me, that was a very strong signal alongside the combination of management and analysts talking about the valuation on earnings call. And what I mean by that is generally it's very rare for analysts and management to directly talk about the valuation of their own stock price. And it's generally only they feel the need to address it when there's such a big discrepancy, or in their opinion or their belief that it's such a big discrepancy between what the market average valuation is versus their current valuation. So for them to be addressing it and sort of talking about, oh yeah, the reason why the stock is where it is, implying that it's undervalued, is because of a major shareholder being forced to liquidate the position. I mean, this is again only a small company, and it makes complete sense. So the fact that something irrational that's not related to the fundamentals of the business is driving this business, is driving the valuation of this company to in effect be lower than it really should be based on sort of market multiples compared to peers, to me is a very strong signal to then know that I'm like looking in the right areas from an investing perspective. Again, if I look at Elf Beauty again, now I must say that these lows were obviously helped by the sort of tariff panics. You did see a lot of things falling, but certainly not to this extent, right? And actually, the reason Elf fell to begin with is the business itself imported about 75% of their products from China. So you think, they are going to be significantly impacted by their tariffs. And they are impacted by their tariffs. But I think one thing the market didn't give them credit for is the fact that they're by far the cheapest price point for makeup products in the US market, right? And just for some context, I think their average price point was like $9 versus mass market products on average like $12 to $13. And then you had per products, I think it might have been 15 off the top of my head. I struggle to remember. And then you had the more premium products, regardless, that were like $25 and upwards per item on average, right? And based on that, you could see that, well, yes, they're going to have a lot more sort of exposure compared to other players that aren't importing from China. You are you are going to be less impacted because ultimately 100% on $5 or $4, however much it is going to be a lot less than competitors that are having to pay, I don't know, double the amount for production. And that was sort of the thesis behind that. And Elf have had a lot of room for pricing. They are by far the cheapest compared to their competitors, and also known for very high quality. Just for some nuance around this business in particular. So, if you knew that and caught on to the fact that actually yes, this business is going to be impacted by them, more likely than not, it's a 2-3 year phenomenon at most, right? And you realize that, oh, actually, this is a business I really like from a fundamental perspective. They are growing. They have grown for the last 5 years. I mean, if we just look at their financials, in fact, rather than just me sort of going on about it, let's have a look, right? So the last 5 years, you will see that their financials have just grown immensely, right? Yes, sure, 2019 to 2020 wasn't significant growth of 6%, then 12%, then 23%, then 47%, then 76%. 28 and 13%. So very respectable. Again, this year's not even finished, right? Very respectable growth, and actually, this has just been driven by consumer demand for this product. It's just been blowing up on social media because of it has been recognized by consumers by the high quality of their products, better oftentimes than the more premium players, and the very, very affordable price points they have. On top of that, they are phenomenal with their marketing. Their marketing team is just amazing there. Yeah, light years ahead of their competitors in that sense, right? So if you are able to recognize that, oh, actually, I'm going to get a business that is at these valuations, again, looking at sort of this range, if I'm going to get a business that is growing 20-30% a year for the next 5 years, more likely than not, again, this is just my own assumptions. And it's at that time it was trading of earnings of 16 times forward earnings, and it's a recession-proof business, which makeup is. Particularly in the lower end of the price point range, you are going to do very well on this investment, in my perspective. That's sort of my thinking. Again, I'm going through my own thoughts here going into this. And again, so not only did we have irrational selling from the fact that the market was overestimating the impacts of what's going to happen here to this business with tariffs, right? We also had, again, management then also sort of being in agreement in that sense in terms of the valuation. And what I mean by this, in this particular example, the way it differed was the management didn't necessarily, in particular, sort of formally address the company being undervalued. Guess what they did do? They did do a massive share repurchase program at that valuation. If the company had stayed at its current valuation, they would have been authorized to buy back between a fifth and a sixth of the entire company. So between 15 to 20% of the entire business, which is just ridiculous for a share buyback program. That's pretty much unheard of. So again, that's just sort of, again, from like an investing perspective, that gave me significant confidence there, right? Another sort of example that we're talking about here is Ring Energy, actually. This is, again, another sort of combination where it's not the exact same example, but it's another combination of irrational selling, in my opinion. Again, that's all subjective, and it's based on your decision at the end of the day as to how you class that. But for me, this is another example of irrational selling and management actually talking and addressing the valuation. Again, of two very strong signals that I've historically found that proves to me I am fishing in the right area for investments. So this particular example, what had happened is, I'll just show you. So business has obviously fallen very significantly, and now obviously oil prices have. This isn't so. Just for context, this business is an oil producer. As oil prices have fallen, they've obviously taken a hit as well. Another part is the fact that they have taken on a lot of debt through doing acquisitions, which have been actually beneficial to growing the business's revenue and net income. It was quite dilutive, and also it had been just quite burdensome in terms of the debt, which is completely fine when you're at normal oil price ranges. However, we are fairly towards the historic low range currently, at around $60 range, and that's sort of part of the reason why this company had fallen. But another significant reason for why the business had actually fallen, that's not really fundamental to the business itself, is the fact that they had their largest shareholder, Warburg Pincus, owned about 30% or more of the business at one time. And about a year and a half ago, 2 years ago, they started selling the business actually, which caused the business to basically have an additional like 10-20% selling pressure every single day. I know that doesn't really sound like a whole lot, but if you build that up over 1.5, 2 years, this is sort of the result. I'm not surprised to see this kind of result going from like $2 again to like 75 cents. And I'm not too concerned about what the stock price is as well per se, but it's just to sort of really demonstrate what's occurring here. The market cap has more than halved, right? And one of the so again, that's irrational selling, and management have addressed this in their earnings calls. This is something that, in fact, they would be probably buying back their shares had they not had covenants on their debt, which basically just means they have rules they need to follow on their debt, and it prevents them from buying back their stock until basically a certain safety threshold is met. So this is again another example of selling for non-fundamental reasons. Again, I'm not addressed. The reason for Warburg Pincus selling is actually because they are an energy fund which focuses on investing in energy, and previously that encompassed all energy, so it included oil, gas, etc. Whereas recently they've actually shifted to a green energy focus, and that has meant that they've been forced to basically liquidate and sell positions in businesses such as Ring Energy, where actually there's nothing wrong with them. It's just that it no longer meets their ESG goals. And again, that's not really fundamental to the business. The business itself hasn't deteriorated. And the fact that selling has occurred because of this just means that the valuation has become more attractive, in my own opinion. And as you can see, I started actually accumulating some shares around. Well, I started accumulating around 75 to 80 cent range, about 77 cents on average. Again, I'm not too concerned with the actual pence amount here or cent amount here. It's more about sort of the reasoning behind it. And actually, it's because I had calculated that based on their average sale rate, which is published in their filings, the how long on average, based on their average sale volume and based on how many shares they had outstanding, you could roughly calculate when when they would fully exit their position. And this was then later confirmed by the company themselves, the energy fund, because the energy fund had to disclose their holdings once a quarter, and actually it was then confirmed at that point. And as you can see, the stock shortly popped 30% after the news, going from 75 cents to $1.10 at the peak, I believe. $1.15 at the peak. So, a 50% increase just off the back of that news. Now, it has retraced some since, and some of these companies have as well, but you can still see they're up fairly significantly across all three examples. On these sort of positions. And the main sort of point that I'm trying to drive home for me as well is one thing I've noticed consistently on some of my best positions have been just businesses that have been sold for unjust reasons, basically, where the fundamentals of the business itself, when you look at it as a business owner, nothing has changed, nothing has degraded, and it's just been sold for whatever technical reason. And it comes in different shapes and sizes. It might be bad press. It might be they're not part of the flavor of the day. I mean, oil and gas is hated, right? So it could be that. It could just be that it's due to liquidations. There are so many reasons for having to sell, and if you can then find ones where it's gotten so depressed to the point where even management is talking about the fact that they believe their investment is or their stock is undervalued, that typically can give you, for me, gives me pretty high conviction that, oh, actually, I'm in the right area here. There is a very high probability that this is actually an undervalued asset that you can take advantage of. And that's sort of been the sort of pattern that I've noticed, and they are sort of examples I will continue to look at. I've actually got another investment that I've started looking at recently. Again, I'm not going to disclose the name on this one because it's one that I've started acquiring recently. And the reason they've had to sell, or the reason they've been selling or had indiscriminatory selling, has been due to the fact that their shareholder base has just completely rotated. And what I mean by that is that the people that used to own the business previously, were typically minority shareholders who were basically individual investors like ourselves. For some of you that may be watching, and what that means is that this company used to offer a healthy dividend of 6 to 8% per year. This business then no longer offers that dividend, and as a result, stock completely plummets, crashes maybe 60-70% for no other reason than the fact they are no longer offering a dividend. The business has changed structure, which has basically meant that they have shifted their focus from just focusing on giving a high yield to investors to now actually focusing on growth. The business had transformed its business model, which has actually led it to improving its fundamentals, improving its future profitability. But as a result of that, they've had to make investments where they've not been able to pay out as much on dividends. You've seen the growth happen. It's just that the dividend hasn't been there. And as a result, it fell 60 to 70%. And you just see management talking about some of the comments on the earnings calls. I mean, you get analysts that are questioning why is it at this valuation currently. Even the analysts themselves who study this are confused by what is going on, and it's because of this shareholder base, indiscriminatory selling. The fundamentals of the business had been improving. It's become more profitable, and in fact, now they could pay a much higher dividend. Based on the current earnings yield, if they really wanted to, they could pay like a 20% dividend. They just choose not to because they can invest that capital at high rates of return to then grow that into an even larger portion of the business. As a result, it's become a very attractive valuation and opportunity for myself. And management have actually said as well that they're not planning. They do still actually offer like a 6-7% dividend yield, but they're not planning to up that anytime soon because they feel that stock is disrespected at its current valuations. And they didn't say that so directly, but they said it through the lens of using a former sort of comedian as an example. They basically said that they're like the Rodney Dangerfield equivalent. I think he used to do a lot of self-depreciating jokes, so that was sort of the hidden meaning behind that. But if you can find these sort of opportunities, I'd be really interested to hear as well. If you do have any comments, I will be responding for sure. So please let me know what you think.